real estate is set to be one of the biggest winners as the Fed moves to cut interest rates, and smart investors can seize this opportunity through REITs. In this video, we're diving into 4 unique, non-traditional REITs that are primed to soar in this low-rate environment. We'll also explore the industry's outlook and highlight one REIT that could potentially turn a $10,000 investment into something extraordinary. Stay tuned to find out which REITs are poised for major growth in the years ahead. Before we jump into our top REIT picks, let's take a moment to assess where we are in the economic cycle and what opportunities lie ahead in today's landscape. For this, we'll use the Vanguard Real Estate Index Fund ETF shares as an example. Over the years, its share price has closely tied to the interest rate changes. During the pandemic, with historically low rates, real estate saw rapid growth. However, between 2022 and late 2023, as interest rates climbed, the ETF share price took a hit. By the end of 2023, market expectations shifted, anticipating a rate cut in 2024, leading to a sideways trend. Fast forward to September 2024, when the Fed officially announced the rate cut, injecting new confidence into the market and sending the share price upward. In the 2010s, residential and retail REITs were the frontrunners in the investment world. However, the landscape has since evolved, offering much more diversity. Investors can now explore more options in industrial, storage, and healthcare. Moreover, REITs continue to be a defensive investment choice, providing investors with the dual advantage of share price appreciation and substantial dividend yields. Now let's explore the REITs that will soar with interest rate cuts. Number 4, we have Alexandria Real Estate Equities, Inc., ticker symbol ARE. This is a pioneer of life science REIT founded in 1994. Alexandria owns, operates, and develops offices and laboratory spaces to biotech, pharmaceutical, and tech companies. Such properties are hard to build, and the threshold is very high. Once the business relationship has developed, tenants are not easily switched. There are 600 tenants, and the top 20 tenants contribute 92% of the rental income. Major tenants include Johnson & Johnson, Pfizer, Moderna, and Eli Lilly. These companies are likely to continue to lease laboratories from Alexandria Real Estate in the next decade and even longer. Over the years, the capital invested in pharmaceutical research and development has been increasing. Back in 2014, the investment was $145 billion. In 2024, this amount will become $272 billion. In 2028, it is expected to be $302 billion. As we can see, there is capital constantly investing in this field, so collecting rent should not be a problem. Now let's take a look at the occupancy rate. At the moment, the occupancy rate is about 95%, which is very high. During the 2008 financial crisis, the occupancy rate only dropped 0.7%. but still above 94%. In the pandemic, the occupancy rate dropped 0.6%, but it recovered very soon. This is where the rental income comes from, and it gives investors peace of mind. After the Fed drops interest rate, Alexandria Real Estate will have more leverage to expand the business. We have a positive outlook for this company in the next few decades. The current dividend yield is 4.29%, and the dividend growth rate was 6.21% in the past 10 years. The share price appreciation was 5.01% in the past 10 years. A $10,000 investment would become $22,654 with an annual dividend of $972 after 10 years. In 20 years, this investment would be $59,039, and the annual dividend would be $2,533. In 30 years, this investment would be $163,032. Now the annual dividend would be $6,994. Number 3, we have Public Storage, ticker symbol PSA. As the largest owner and operator of self-storage facilities in the world, the company is leasing 170 million square feet of real estate in the US and Europe. Their strategy focuses on investing in high-demand locations where customer needs are the greatest. This significant presence in metropolitan areas has made Public Storage one of the most recognized and established brands in the industry. In recent years, Public Storage is actively adopting new technology for revenue optimization and cost reduction. Looking at their financials, revenue grew from $2.925 billion in 2019 to an impressive $4.659 billion in 2023, showcasing strong growth. When we examine cash flow, free cash flow per share was $10.55 in 2019, dipped slightly to $10.44 in 2020 during the pandemic, but surged to $17.15 in 2023. Now we can see the company's investment strategy is in line with Warren Buffett's investment philosophy. Simple business model, strong fundamentals, and great cash flow. The current dividend yield is 3.32%, and the dividend growth rate was 7.92% in the past 10 years. The share price appreciation was 8.17% in the past 10 years. A $10,000 investment would become $26,544 with an annual dividend of $862 after 10 years. In 20 years, this investment would be $77,988, and the annual dividend would be $2,469. In 30 years, this investment would be $227,508. Now the annual dividend would be $7,024. Number 2, we have Vici Properties, ticker symbol VICI. This REIT specializes in experiential real estate with a portfolio that includes gaming, hospitality, entertainment, and leisure destinations. There are a total of 93 properties spanning in 26 states and 1 Canadian province, providing a well-diversified risk profile. Unlike other REITs, Vici owns unique and high-value assets, including multiple iconic gaming properties in downtown Las Vegas, a market that's not easily penetrated by other REITs due to the high barriers of entry. The revenue generated by each of these casinos is significantly higher than that of typical properties, giving Vici a substantial competitive edge. As we can see on this map, Vici's properties are almost everywhere throughout downtown Las Vegas. As for the tenants, there are only 13 of them because the bar to become a tenant of Vici is very high. In fact, they are contributing $3.6 billion of rental income in 2023. Given the difficulty of obtaining a gaming license, Vici's average lease term extends up to 42 years, significantly longer than the typical 8 to 14 years seen in other REITs. This long-term stability will greatly benefit investors. It is also worth noting that all tenants have consistently paid their rent on time, even during the challenges of the pandemic. The current dividend yield is 5.23%, and the dividend growth rate was 7.66% in the past 5 years. The share price appreciation was 7.59% in the past 5 years. A $10,000 investment would become $29,647 with an annual dividend of $1,560 after 10 years. In 20 years, this investment would be $99,484, and the annual dividend would be $5,273. In 30 years, this investment would be $334,929. Now the annual dividend would be $17,876. Number 1, we have Prologis Inc., ticker symbol PLD. Prologis focuses on building, owning, and managing logistic real estate near the key transportation hubs like airports, seaports, and highways. Strong demand for distribution centers from Prologis has fueled their solid performance for years. With 3,319 facilities spreading across 19 countries on 4 continents, Prologis manages a vast portfolio totaling 684 million square feet and $72 billion in assets. Every year, about 2.8% of the world's GDP passes through their distribution centers, highlighting Prologis' vital role in the global supply chain. With the surge of e-commerce, the demand for logistic infrastructure and efficient distribution networks is much higher, directly benefiting Prologis. The top 3 customers are Amazon, Home Depot, and Geodis. They combine to occupy 77.9% of the warehouses. Amazon alone is taking 43.5% of the warehouses. This tenant base ensures rental income stability and reinforces the strength of their business. With such a solid foundation, Prologis is able to expand business through acquisitions and developments. Until the end of the year, Prologis is expected to spend $1.5 billion on acquisitions. As the interest rate goes down in the near future, the company can leverage much more capital to acquire more land to expand business. The current dividend yield is 3.06%, and the dividend growth rate was 11.44% in the past 10 years. The share price appreciation was 12.68% in the past 10 years. A $10,000 investment would be $36,844 with an annual dividend of $1,008 in 10 years. In 20 years, this investment would be $152,554, and the annual dividend would be $3,682. In 30 years, this investment would be $615,227. Now the annual dividend would be $13,110. These are the 4 REITs that will soar with interest rate cuts. Thanks for watching. Be sure to hit the like and subscribe button for more helpful tips like this. See you in the next video.